You walk into a bank. You ask for a $50,000 loan. The loan officer checks your credit, nods, and types something into their computer. 3 days later, $50,000 appears in your account. Here's the question nobody asks. Where did that money come from? You probably assume the bank had it sitting somewhere, in a vault, or in someone else's savings account. That's what most people think. That the bank is just a middleman, moving money from people who have it to people who need it. That's not what happens. The bank didn't move money from anywhere. They created it, out of nothing. The moment you signed that loan document, they conjured $50,000 into existence with a few keystrokes. No vault, no transfer, just new money added to the total supply because you promised to pay it back. This isn't a conspiracy theory. It's not a glitch. It's exactly how the system is designed to work, and almost no one understands it. Let's rewind for a second. Most people learn about money the same way. You earn it, you save it, you spend it. Money is a thing, a scarce thing. Something you have to work for, something that exists in a fixed amount somewhere and gets passed around. That mental model makes sense for your personal finances, but it completely falls apart when you zoom out to how banks actually operate. Because banks don't operate like you do. They operate under a different set of rules. Rules that allow them to do something that would be illegal for anyone else. Create money. Here's how it works. You take out that $50,000 loan. The bank doesn't check if they have $50,000 in cash. They check if you're creditworthy. If you are, they open up their ledger software and type in 2 entries. On one side, they create a $50,000 deposit in your account. That's your money now. You can spend it. On the other side, they create a $50,000 loan asset. That's what you owe them plus interest. Both sides balance. But here's the magic. Before this transaction, that $50,000 didn't exist anywhere in the economy. The bank didn't take it from someone else's account. They didn't pull it from reserves. They just created it. And now it's real. You can use it to buy a car, pay for a wedding, start a business. It spends like any other dollar. This process is called fractional reserve banking, but that name makes it sound more complicated than it is. The simple version is this. Banks are allowed to create new money every time they issue a loan, and they do it billions of times a day. Now you might be thinking, wait, if banks can just create money whenever someone takes a loan, why can't they create infinite money? Why isn't everyone infinitely rich? Good question. There are limits, just not the ones you'd expect. Banks do have to keep a certain amount of actual reserves on hand. For decades, that reserve requirement was around 10%. Meaning if a bank created $1 million in new loans, they needed to have at least $100,000 in reserves at the central bank. That was the brake on the system, the thing that kept it from spiraling out of control. But in March 2020, the Federal Reserve made a quiet change. They dropped the reserve requirement to 0, not 2%, not 1%, 0. That means technically, a bank can now issue as many loans as they want without holding any reserves at all. The only real limit left is whether they think you'll pay it back. If you're creditworthy, they'll create the money. If you're not, they won't. So the constraint isn't how much money exists. It's how much debt people are willing to take on, and how much risk banks are willing to accept. That's a very different kind of limit. Let's follow the money for a second. You get your $50,000 loan. You use it to pay a contractor to renovate your house. The contractor deposits that $50,000 into their bank account. Now here's where it gets weird. That $50,000 you just spent? It's still in the system, sitting in the contractor's account, and now their bank can use that deposit as the basis to create even more money. They can issue new loans against it. Let's say they lend out $45,000 to someone else. Now that person spends it, and it gets deposited into another account, and that bank can lend against it again. The original $50,000 has now turned into something closer to $150,000 in total money supply. None of it existed before you took out that first loan. It was all created on the way up. Each bank in the chain added a little more. This is called the money multiplier effect, and it's how a relatively small amount of base money gets amplified into trillions of dollars moving through the economy. In 2023, there was about $2 trillion in physical currency in circulation in the United States. But the total money supply, the number called M2, which includes checking accounts, savings accounts, and other liquid assets, was over $21 trillion. That extra $19 trillion wasn't printed. It was created by banks issuing loans. Most of the money in the economy isn't cash. It's credit. It's promises to pay, typed into a computer, backed by nothing but trust that the system will hold together. Now here's the part that should bother you. When you take out that loan, you have to pay it back with interest. Let's say your $50,000 loan has a 5% interest rate over 10 years. By the time you're done, you'll have paid back something like $63,000. $50,000 in principal, $13,000 in interest. The bank created the $50,000 out of nothing, but you have to earn every single dollar of that $63,000 through your labor, your time, your effort. You're paying back money that didn't exist before the loan, plus interest on top of it, with money that you had to work for. And here's the kicker. The interest you're paying, that money was never created in the first place. Think about it. The bank created $50,000 when they issued your loan, but they didn't create the $13,000 you owe in interest. That money has to come from somewhere else in the economy, which means someone else has to take out another loan, creating more money just to keep the whole system liquid enough for you to pay your interest. This creates a structural problem. The system requires constant growth, constant new loans, constant expansion of the money supply. Because if lending slows down, there's not enough money in circulation to pay back all the interest everyone owes. And that's when things start to break. Let's zoom out. In 1960, total U.S. household debt was around $200 billion. By 2000, it was $7 trillion. Today, it's over $17 trillion. That's not because people suddenly got more irresponsible. It's because the system requires more and more debt to function. Every time a loan gets paid off, money disappears. It gets destroyed. The same way it was created. When you make your monthly payment, the bank reduces your loan balance on one side of the ledger and removes money from your account on the other. The money vanishes. So to keep the total money supply from shrinking, banks have to issue new loans faster than old ones are being paid off. This is why central banks care so much about lending. Why they cut interest rates during recessions. Why they panicked in 2008 when banks stopped lending. Because if the flow of new loans stops, the money supply contracts. And if the money supply contracts, people can't pay their debts. And if people can't pay their debts, banks fail. And if banks fail, the whole thing collapses. The system isn't built on stability, it's built on growth, endless growth, exponential growth, and the fuel for that growth is your willingness to go into debt. Here's the irony. We talk about inflation like it's this mysterious force. Like prices just go up because of supply and demand or government spending or corporate greed. And sure, those things matter. But the biggest driver of inflation over time is money creation. And most money creation doesn't come from the government printing cash. It comes from banks issuing loans. Every time someone takes out a mortgage, an auto loan, a business loan, new money enters the economy. More dollars chasing the same amount of goods. Which means, over time, prices rise. The value of each dollar falls. Not because the government printed it, but because a bank created it, and you promised to pay it back. And the wildest part? The bank doesn't even need to have the money to create it. They just need you to believe you owe it. There's a quote that gets thrown around in finance. It's usually attributed to Henry Ford, though no one's sure he actually said it. But it goes like this. It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. Whether Ford said it or not, the point stands. Most people go their entire lives without understanding how money is actually created. They think banks are just middlemen. They think loans come from savings. They think the system is neutral. And because they don't understand it, they don't question it. But once you see it, you can't unsee it. Banks create money when they lend. You destroy it when you pay it back. And in between, you pay interest on money that never existed in the first place. The system requires you to take on more debt just to keep itself alive. And the people who benefit most are the ones closest to the point of creation. The banks, the financial institutions, the ones who get to create money with a keystroke and charge you interest for the privilege. So the next time you take out a loan, ask yourself this: where did that money really come from? And when you pay it back, where does it go? The answer isn't what you think.